Hello, everybody. Welcome to Asymmetric Investing. Ask me anything as we get things rolling here and we let people jump in. Just wanted to kind of give you an idea of what the idea here is today. The market. I want to try to do these first of all once a month. So I typically do one of these on the premium side after I come out with my monthly buys for the Asymmetric Investing newsletter. So I will do that probably either late next week or early the following week. But with everything that's going on in the market, and things looked like they were going to be down pretty significantly when I sent out the notice to newsletter subscribers last night. Things obviously changed early in the market today, so things are up a little bit in trading on early Monday morning. But there's been a lot going on, a lot of chaos in the market. So I just wanted to kind of make myself available for any questions that you had about things that are going on in the market. Just kind of give some overall ideas about how I'm thinking about investing right now. Nothing has changed about the philosophy in asymmetric investing. I am still thinking about what are companies going to look like 10 years from now, 20 years from now. The thing that's changed in the short term is sentiment. And obviously, the war in Iran and what's going on with energy prices and what's going to happen with the economy. There's been a huge shift in kind of where money is starting to go. So I want to start with that. And I'll get to some of these questions, and I'm actually going to layer in one that came from Austin here. The question is the S&P 500. And I'll read the full question because it's a little bit longer than this. But the S&P 500 is only down 9%, but the backdrop feels shaky. The Fed has paused rate cuts. Inflation is ticking up. Private credit looks wonky. I think that's probably the right thing to say about private credit right now. It's not a real transparent industry, so it's very opaque. So could there be something great financial crisis like in private credit? Possible. We just don't know right now. AI CapEx ROI is unclear. Could be really high, could be not so high, depending on what happens in the future. Housing is weak, oil is spiking, supply chains are getting hit. Like for example, fertilizer, layoffs are accelerating, and we're in a war. From here, what drives the move to minus 20% versus a recovery back to highs? Here's a good opportunity to kind of go through what we've seen in the market. And I wanted to start with this to just give you an idea of where the money is moving right now. Because I think that's the challenge at the moment is that the trade, if you will, is kind of a risk off trade. So this is the year to date heat map for the S&P 500. So what you're seeing here is a lot of the popular names of the past 5 years or so have really taken it on the chin. Microsoft down 25%. This was supposed to be the big no-brainer in artificial intelligence. Apple's down almost 10%. You know, Amazon, Tesla, Meta, Google. This is kind of an unwinding of some of the bullishness around artificial intelligence, at least early this year. And then you have things like financials. So what's going to go on with the economy? Well, investors are starting to say maybe we need to be a little less bullish on financials and asset management, financial data, all of these kinds of, is there going to be disruption? That's kind of the other question with software. The one green spot in the middle here is going to be semiconductor companies, in particular companies that have exposure to memory in one way, shape, or form. So Micron is obviously a big one, but then you're going to get the equipment companies as well because there's a ton of demand for equipment for artificial intelligence chips, and they also make the equipment that makes memory chips as well. So that's why you get this kind of green pocket among a sea of red on the left-hand side. Okay, but focus on where there's green in 2026 because this is what's really interesting. Consumer defensive. Walmart is up 12%. Costco 16%. You got Coca-Cola, Pepsi. Tobacco stocks are outperforming the market. Oil and gas, utilities is over here on the left. So there's a whole bunch of utilities. All of these are up, or most of these are up double digits, if not over 20%. Oil and gas, exploration companies. All of these are kind of a flight to the top right. I think of it as a flight to, hey, if you're worried about disruption from something like, artificial intelligence in SaaS stocks, for example, you're going to go, what do I know is going to exist 20 years from now? Walmart's probably going to exist 20 years from now. Costco is probably going to exist. We're probably still going to be buying Coca-Cola 20 years from now. I want to get to some of those multiples in just a second because that's what's gotten a little bit crazy is that like Walmart is trading for something like 40 times earnings. That's crazy. But the market short term does a lot of really crazy things. Let's also do this and go over to this is the 5-year returns from the S&P 500. So the same exact heat map, but now we're looking, or sorry, 3 years. But now this is looking back 3 years. Now you're starting to get a little bit different look of what's going on. Obviously, Nvidia, big outlier here. We all know exactly why. Google's done really well. Amazon's up 100%. The story really starts to change. Now you start to see the left side of this entire heat map do a little bit better. And what you're seeing is the right side not outperform quite as much, even though it's been a really good start to 2026. ExxonMobil, pretty good run, but a lot of that is in the last year or so. Utilities not performing nearly as well. A lot of these utilities were flat clearly for the 2 years prior. Pepsi down 13% over the last 3 years. Okay, so now the story starts to change. Let's go back even further. This is to the last 10 years. So this is the 10-year return. Again, outliers on the left-hand side. So this is going to be technology companies that are compounding revenue growth. These are the ones that we want to be investing in that are going to do this over the next 10 years. But look at what happened in consumer defensive over the past 10 years. Walmart's done all right. Costco's done all right. Target, not so much. Dollar General, not so much. Coca-Cola, up 65% in 10 years. That's not great. Pepsi, same thing. Philip Morris, the returns, utilities, doubling your money over 10 years. That's not even matching the performance of the market. So what we're seeing here is a shift from the things that have done well over the last 3, 5, 10 years, shift into a more defensive stance. Okay, so we've got that. Let's see, I think I have it in here. But here's the thing that I think is important when you look at that trend is what some of these stocks are now trading for. Because if you go, well, energy has done really well, or consumer defensive has done really well. Travis, why weren't you investing in that? Because these are not cheap stocks. These are, look at Walmart, 45 price to earnings multiple. And the compound annual growth rate over the last decade, the last 10 years, is 3.9%. That's not a growth company. That's not a company that long-term deserves to trade for this multiple unless you think that that multiple is going to expand in the future. This is kind of the real challenge of the market today, is that the companies that are performing well operationally does not mean that their stocks are performing well over the past 3 months in particular. So that's kind of the framing that I wanted to have here. I added a few other companies that are doing well short term. Caterpillar, price earnings multiple is 36. This is a stock that periodically trades for a price earnings multiple in the single digits. Forward basis, you get to 29. But look at this 10-year compound annual revenue growth rate, 3.7%. What does that deserve to trade for? ExxonMobil, same thing. 10-year compound annual growth rate of ExxonMobil, 2.2%. And yet, it's gone parabolic over the past 3 months. Now trading for, 20 times earnings, 20 times forward earnings. Those could be elevated earnings because of high energy prices. So long term is now the time to buy ExxonMobil? I don't think so. And this is not a company that I want to be holding long term for the same reason. And then you look at something that hasn't done well that's in the asymmetric portfolio. There's a few questions about hims and hers, so I just added them to this. Enterprise value to sales. Okay, let's go back to a couple of these. Enterprise value to sales of ExxonMobil 2.4. Caterpillar 5.1. Walmart 1.5. Okay, these are all companies growing in the low single digits. Hims and hers 2.1 enterprise value to sales multiple, and the 5-year compound annual growth rate is 74%. So when you look at the way that I invest in asymmetric investing, I'm looking at what are those companies that can be those massive outperformers that are trading for a pretty cheap multiple. Now, the thing to bring into this is I may be wrong about any one of these single stocks. But if I've got a portfolio of 20 plus stocks that all have these similar characteristics. They're growth companies, they're trading for reasonable multiples, they have good balance sheets, they have strong cash flow. That's generally where I'm over indexing in everything in the portfolio. This is going to be how you beat the market long term, but there's going to be a ton of volatility along the way. That's exactly what you see here, is just volatility like crazy. You could go through any one of the stocks in the portfolio. Oh, Transmedics, I'll talk about that in a little bit. So, that I just wanted to put that background on what's going on in the S&P 500. Same thing in the Nasdaq. One of the reasons that the S&P 500 is outperforming the Nasdaq is because the S&P 500 has those energy stocks and the Nasdaq just doesn't. So then the second part of the question is, what could potentially drive the market down 20% versus back to all-time highs? And this is where you get to something that I've been writing about for probably a few months now. The valuation of the market overall is still very close to the all-time highs. If you just look at, see if I can find it quickly. The P multiple. Okay, so this is multiple.com. I'll just bring this up here again. So if you look at the multiple, the price to earnings multiple for the entire S&P 500. So right now it's 27.25. When has that ever been over 27.25? Well, you can see historically there was never a point before the dot-com bubble, before late in the 90s, that it got over about 25, 26. So what happens here? Valuations go up in the dot-com bubble. Okay, got up to a 46 price to earnings multiple. And then two things happen. So the valuations are high. Then when you hit the recession that happens in 2001, the E part of the price to earnings multiple starts to come down. So now stocks look even more expensive. So if your price stays flat and your earnings go down, now your price to earnings multiple goes up. And then your stocks start to come down and the multiples compress. So you get earnings coming down and multiples coming down. That's how you get this lost decade from 2001. The market peaked in, I believe it was March of 2000, all the way through 2013, I believe it was, that the Nasdaq finally hit its highs that it hit in 2000. So what could potentially be parallels here? Well, we're at a high price to earnings multiple on a relative basis. So let's say that we go into a recession. Let's say we go into an oil-driven recession. So oil goes to $150 a barrel, $200 a barrel. Don't think this is crazy. This has happened before. We were at $140 a barrel. That basically drove us into the great financial crisis. So if that happens, people start spending more on oil. Regular people start spending more on oil. They start spending a little less on everything else. Maybe you go out to eat a little bit less. Maybe you buy a few less pieces of clothing. Maybe you don't go on that trip that you were thinking about. You don't buy the vehicle. And so that starts to end up being a spiral. A good economy is a spiral upward. A bad economy is a spiral downward. That would be potentially what happens, is you get a negative feedback loop in the economy, and then you also get multiple compression. So we go from a 27 price to earnings multiple for the S&P 500 to, let's just go to where we were in 2011, 15. Like the entire market traded for a 15 price to earnings multiple. That wasn't that long ago. That was 15 years ago. You go back to the bottom in 2006. It was, 16 then as well. So those are not unheard of multiples. That would be more than a 20% drop today, just from multiple compression, not from anything economic, not from going into a recession, not from the E in price to earnings multiple going down. So that's the thing to think about, is what's going on in the economy, and when will is the market going to be willing to pay up for companies that are performing well, or even that aren't performing well? Is Walmart going to deserve a price to earnings multiple of 40 if it turns out their earnings are flat in 2026 and in 2027? Maybe even things go down a little bit. Or do those multiples compress and that multiple goes to PE multiple of 20 or 15? That's where, the thing that I wrote, I think a week ago, a little over a week ago, was we have not been in a real recession in 17 years. So if you were not investing in 2008, in 2009, in 2000, in 2001, 2002, 2003, it's really hard to explain what it feels like when it feels like everyone's losing their job, nobody's spending money, every earnings report is terrible, the stock market's dropping every day. Like, it felt like that in 2020 for like 5 minutes. And then the money helicopter started. We are not in that same scenario. This may just be a normal recession, but we have not had a normal recession in 17 years. So that's something that I think about a lot. That does not change anything about the way that I'm investing. I have this pool of stocks that I think are companies that are doing well, that I think are trading for reasonable multiples today. If those stocks get cheaper and the fundamental thesis behind them doesn't change, I'm happy to buy more. I'm happy to buy more. The companies that I owned prior to the great financial crisis, Las Vegas Sands, Chipotle, Apple. If I would have just held on to everything that I owned then, I would have been up 20x or something like that over the next 15 years. So those are lessons that I've learned the hard way of you got to just keep your head if we do go through a pullback of 20% or more in the S&P 500, you got to keep your head. You got to just be able to make it through this and buy bigger and bigger pieces of these companies that are going to do really well long term. If you have questions, put them in the comments. I'm going to get to a couple of these that are that came in from the newsletter here because I was prepared for those a little bit. So let me get to hims and hers, and I think one of the questions that came in live. Oops, that was not the right one. Here we go. What percentage of your portfolio is in HIMS as we are speaking? Let me pull this up. I think it's about 8%. And this is of the asymmetric portfolio. So that's what I'm building in public. Yeah, 8% of the portfolio right now is in HIMS and HERS. I'm comfortable with that being where it is. It has been over 10. I think it almost got to 15 at one point. But that's what makes you get big moves like you get with HIMS and HERS. You get big moves like you have with Robinhood that were kind of overweight in the portfolio, drove the performance in 2025. Some of those things reverse. It can look pretty rough over a short period of time. Okay, let's get to a few things with HIMS and HERS. I'll add this up on my screen here. And I got a couple of things I think prepared here that I will also try to bring up. So we'll have a mini HIM segment here. How do you view HIM's competitive positioning versus peers like Roe, distribution incumbents like Amazon and Walmart, trillion-dollar pharmaceutical companies like Eli Lilly? Can HIMS create scale and distribution it needs to succeed? Okay, so let's start there because the big thesis behind HIMS and HERS is that this is a company that is going to own demand. So if you go back to everything that I have written, done videos about with things like the smiling curve, what ends up happening on the internet. So you go back to the 80s, 90s, 70s, the market was really driven by supply and distribution. Who had the power to go into a retail store and say, you know what? We're selling Coca-Cola. If you want to sell Coca-Cola, that's what people come in and ask for. You can't have this local brand on your shelf. So the power was with those suppliers because they could hold, retailers, bars, restaurants hostage, basically, because that's all that people knew. People didn't know if you had a random mustard brand. This is the stuff that's popping up in like your local grocery store. You have a random mustard brand or a random salsa brand. Today, you could go to a grocery store and get some shelf space. Previously, that was not the case because the distribution relationships were more important than those small mom and pop shop relationships. And you had nowhere else to go. You didn't have a Shopify. in 1995. So what changes on the internet is now suddenly your audience is infinite. So now you can put up a Shopify page and you could have somebody order from California, you could have somebody order from Europe, and you can build a viable business model. That was not the case, 20 years ago. So that has really shifted. And if you look at that long-term performance of companies like Pepsi, Coca-Cola, Budweiser, Kraft Heinz, you're seeing the shift in power from supply to demand. And what do I mean by that? When customers choose to go to your app or your website or your service, that means that you own that demand. So Uber owns demand of ride sharing and now of a lot of food. So that's a powerful position to be in because now suddenly supply has to come to you. So a restaurant has to come to you and say, "Hey, we want to be on Uber," and that's how the business model works. But the demand comes first. The demand is the most important thing. Doesn't necessarily come first. I shouldn't say that. But but that demand is where the power is. The power is not with supply. The power is not with a certain restaurant saying, "Hey, if you want me to be on your app, you got to give me preferable terms." Like Uber can just say, "Okay, buzz off." So Hims and Hers is in an early phase of potentially being that company in healthcare. That's what fundamentally makes me excited about the 10x, 100x potential for Hims and Hers. If this is the place that you go, "Hey, I want to." Right now, the modalities would be looking at hair loss, weight loss, ED, um, hormone treatments, a couple of other things. That is where they are today. But think about adding all kinds of things in the future. Even in my Spotlight article, which was, gosh, almost 2 years ago at this point, I talked about we have to buy EpiPens for my daughter every year. Why isn't that something I can just go on Hims and Hers and be like, we got a prescription. It's not a massive deal to get an EpiPen, but it would be a hell of a lot better experience if I didn't have to physically go to the pharmacy, if I don't have to negotiate with them about like, do you have these coupons? How much is it going to cost? Is it going to be $0 this time? Is it going to be $600 this time? I'm happy to pay for an EpiPen, but the medicine in that is like $1. And yesterday, my wife paid $600 for that EpiPen. So there's an opportunity there to be that source of demand, the place that I go to get my prescriptions filled, get my healthcare questions answered. If you have kids, you have a million questions to get answered on an ongoing basis. So that is sort of the thesis, is that they become a platform, they become that point of demand. What makes that interesting with the Novo deal is that to do that, you have to have suppliers working with you. And that's what I saw with that Novo deal. I wouldn't be surprised if we see a Lilly deal later this year. Retatrutide is likely coming, but I'll show some of the pricing of some of their products in just a second. But there's that is still the potential for the company. So can Amazon do that better than Hims and Hers? Possibly, but that's not what Amazon does. So if you think that Amazon is going to do healthcare better than Hims and Hers, why do you own anything but Amazon? And I think we're getting to the point with Amazon where they do some things really, really well, but they're at such a scale that they can't focus on these kind of smaller, more niche segments the same way. So if you have a prescription and you know exactly what you need, they're going to do CVS better than CVS can do CVS. Are they going to be a company that you interact with, that you get information from, that you get, the Hims and Hers as part of the Novo deal is now launching these memberships where you're supposedly getting nutrition help. So are they going to say, okay, we'll give you a Wegovy pill and we'll help you figure out how to eat a little bit better. We'll line you up with some workout plans. I don't think that's where Amazon goes. And I think we're starting to see that in a lot of different markets where just saying, oh, Amazon's competing with you, you're screwed. That I don't think that's where we are at this point. So I I'm keeping an eye on them as competitors, but I'm not incredibly worried about them. Um, okay, let's get into a couple of other questions that Austin had. because I think this is important. He asked about the customer acquisition cost for Hims and Hers expanding. Does Hims and Hers balance expanding LTV and the customer of existing customers versus the expanding cost overall? And then to support top line growth, do you think Hims and Hers will rely on revenue growth through acquisitions, or will they grow organically? Okay, it's a lot of stuff there. So remember, the whole thesis behind this company is that they're going to be the aggregator of demand in healthcare. Okay, so you want to be a company that is operating as big a scale as possible. If you look at what's the goal today, it's to go from 2.5 million subscribers to 20 million subscribers, 50 million subscribers. If they get to that point, then who has the power in a relationship between them and like a pharmaceutical company, for example? The power dynamic really shifts. Customer acquisition costs, because this is a good thing to look at. So I just looked at where they started was with ED, and the thing with their ED treatments is they're relatively low cost. So if you look at $39 per month, what are they gonna make in a margin there? They're 80% margin. So that's not going to be a super high margin product from an operating expense perspective. I'll just let me pull my calculator out here. So let's say they make an 80% margin and you have customers last for 6 months. So that's $187 in gross margin. So your customer acquisition cost better be $187 or lower. Then let's move over to something like their Wegovy treatments, Ozempic, and then you have Lilly with Mounjaro and Zepbound here. So the way that this is working is, and this is in this like these small notes down here, requires this membership. This is what Row has as well. But so $39 for the first month, and auto renews at $149 thereafter. So let's say that the economics are Hims and Hers makes $0 off of selling the actual pill or the pen. I assume there's probably some margin there, but 100% of their margin is with this membership that you have to have. So now, instead of having a margin of $31 a month, your gross margin is $149 per month. So now you're looking at, so 187 was the cost you had to be under previously with the ED treatments. Now you're talking about $900. So your gross margin potential goes up, even if your gross margin, if we assume that they get zero margin out of this and 100% gross margin out of the membership, your gross margin percentage goes down, but your gross margin dollars go up. Okay. So this is where you're going to see some of these things. This is the gross margin percentage, and I have this all in trailing 12 months. This is going down, but their gross margins, I'm locked in some of these things here, are actually starting to, their operating margins are going up. So that's what you want to see with a company like Hims and Hers, is in the future, are they expanding basically the overall dollars by moving into those higher value categories? And something like ED is like a Trojan horse, right? That's not the end goal. The end goal is not to be this is how so many great businesses start, is you start with something silly and you end up building something. I mean, Instagram was a photo filter app. That is now, what would that be worth on its own? $500 billion. So that's kind of the way to, I think about Hims and Hers. A lot of ifs, thens, a lot of execution to do, but you look at the price to sales multiple of 2, the fact that they have shown that they can grow the business at a 74% compound annual growth rate over the past 5 years. I think the risk reward is still really strong. They got a lot of questions to answer over the next few quarters. But I think I like the direction that they're going. Now you got to continue to win in the market. The other thing that's always hard to think about with some of these disruptive technologies is it's really easy to ask why the incumbent doesn't win. Why doesn't Sears win when the internet comes around? Because they just fundamentally can't think like an internet company. And it's so easily visible in hindsight, but it's not quite as visible when you're at this phase of disruption, because it's easy to go, well, Eli Lilly has a direct thing, Novo Direct exists, you have Amazon. Why aren't those existing companies going to win? Well, what is Hims and Hers going to develop over the next 10 years that is just going to be that incrementally better, that incremental improvement is going to continue to compound on itself? They've Trojan horse their way into the industry. Millions of people, I think they're up to, with the two acquisitions, Zava and Eucalyptus in Australia, they're going to be probably around 4.5 million subscribers. Now we have Novo on board. Is that going to push their growth a little bit higher this year? That's how you get to the point where this flywheel starts to kind of kick in, and you go, okay, we're growing, we have more subscribers, now we're offering more things, we're adding more value to more people. We'll see how things play out, but if I have 10, 15, 20 of those kinds of stocks with that kind of risk reward, that's where I want to be. Have I looked at Transmedics? Yes, I have. I pulled their information up. I don't have super strong views on Transmedics, and maybe it's me just not understanding their business super well, but it hasn't gotten to a point. Let me just, I know this is one of those that a lot of people who, are on Twitter or YouTube, really like Transmedics. Price earnings multiple on a forward basis is 32. Enterprise value to sales on a forward basis is also over 4. So we're kind of at the point in, I know that the 3 and 5 year growth rate is really high, but if you look at their past, let's look at the quarterly numbers. Things have kind of flattened out. Probably one that I need to learn a little bit more about. But I don't have, it's not in the portfolio. It's on my radar. So it's on a list of, let's say 20 stocks that if we start to get a dislocation and I go, well, is this valuation really attractive? It's definitely on my list. So hopefully that helps. The other question that I had come in ahead of time is that I'll pop in here in the chat. Are you considering reducing the portfolio to the best 10x ideas now that so many positions are down significantly? Good question. The short answer is no. And the reason is, and this is really the hard thing with investing, it's really easy to build strong conviction in something and then not come back and go, you know what, but I might be wrong. So right now, I think there's 23, 24 stocks in the asymmetric portfolio. There is a reason that I bought every single one of them. There is a long-term thesis with every single one of them. I am not 100% sure which ones are going to be correct, which ones are going to 10x over the next 10 years, and which ones are going to go to 0. So that acknowledgement is why I build that relatively diverse portfolio. There's a lot of correlation because they're all growth. Typically, most of them are growth stocks. But, am I going to kind of like go all in on my best 5 ideas? No, because what if I'm wrong on 3 of them? Then that hits your returns really hard unless you're 100% right on the other 2. So, I go back to, like, I sold Chipotle after making a really good gain in something like 2007 or 2008. I think I doubled my money, tripled my money. Best thing to do was just hang on to it. I had the thing. I owned the thing. Same thing with Apple. I bought Apple. I remember buying Apple at like a price to earnings multiple after you pulled out cash of like 8 in 2009. Just hang on to that. That was my mistake, and my learning is, look, if I've done the work on a stock that is my number 11 stock, but I have 10 better ideas, what if number 11 is the one that actually works out? It ends up being 100x stock that blows away all the returns for all the rest of my investments. So unless there's something that fundamentally changes about an investment thesis or the way that I'm thinking about an industry, I typically don't. I over-index to not selling anything in the asymmetric portfolio. Doesn't mean I don't sell anything. I have sold a few times in the past 3 or 4 months, but it's got to be something really fundamental that has changed. I sold Celsius. That was actually pretty fortunate timing there. But it wasn't a company that was growing organically the way that I thought it used to. It made a really good acquisition with Alani Nu, and I just went, you know what? I got a nice profit here. I'm going to take this off the table because I just don't love where they're going right now in the future. So hopefully that's helpful in understanding why I'm not, doubling down on my 10 best ideas. The other thing is, if Austin's first question is right and we do go down another 20% from here, which one's going to go down 50% and be a steal? Which one is going to not? I'm trying to just be I want to put my thesis out there about all these investments. I also want to acknowledge the entire point of asymmetric investing is to acknowledge that I might be wrong about any one of these. Okay. I'm going to try to go through these questions as they come through. So got to that one. Disney and Pawn. Oh, Palo Alto. I don't follow Palo Alto networks. Just kind of that area is not one that I dig into. It's not my area of expertise. So that's why you're not going to see a lot of Palo Alto networks for me. Disney, I love where they're sitting right now, and the market hates it. A lot of investors hate it. But if you look at, think about those companies that I talked about earlier, like Coca-Cola, like Walmart. Disney isn't going to exist 20, 30, 40 years from now. And the valuation is not that bad. Just look at this here. Price to earnings multiple on a forward basis, it's 13. This is, I would argue that this is probably the second most valuable subscription streaming service. So YouTube's the biggest. Netflix is second, and I think Disney's third. When you put Disney Plus with Hulu and then add ESPN in there, that maybe they sell ESPN or spin off the networks, things like that. But let's not forget, this is a company with a $200 billion enterprise value, and their parks are generating over $10 billion in operating profit. That's only going up from here. That's the moat. You may not like their movies. Guess what? I got little kids. We're going to Disney World soon because it's just one of those things that is just a core, core memory, right? To go to the movie. I like the risk reward right now. Does it 10x over the next 10 years? If they get their movies right, if they get streaming right, it absolutely can. It did in the early days of Iger. I think it almost 10x'd in those first 10 years or so. And then going back to, I'm blanking on the name of the CEO in the 80s, Eisen. But had phenomenal returns then as well. So I like the risk reward for Disney right now. Thoughts on the banking industry, like SoFi, Robinhood, as people would be talking, seem to be taking out a lot of debt. A little bit different risk rewards. So when I added SoFi and Robinhood to the asymmetric portfolio, I actually did it as a basket because I didn't know. I like the idea of my little personal story was I would drive around and they were building these bank branches. And I think I had just opened up a Robinhood account and I'd seen some of their new gold card had just come out. And I was going, how can you offer 3% cash back? Because that means you're losing money on every single transaction. And something hit me that was just, they're playing a completely different game than all these traditional banks because the traditional banks are still building branches. You still have people wearing suits in branches, just being fixed costs. And Robinhood, I'll pull up Robinhood's numbers here, but you're starting to see that operating leverage kick in, and there's no reason to think that operating leverage is not going to continue for the foreseeable future. This Robinhood in particular will be volatile. Let's just go to trailing 12 months. I can pull this back here. So they've got phenomenal operating leverage in the business. There's no reason that doesn't continue for the foreseeable future for Robinhood. Now, does revenue get a little bit volatile? Yeah, that's probably the case for them because you're going to have risks come in. It's been a ton of tailwinds for both them and SoFi over the past couple of years as they've moved into things like debit cards and credit cards and savings accounts and all this stuff. You're going to eventually get to a point where the market goes down. We saw this in 2022. Trading on Robinhood dries up because they have a lot of options activity, but they're a much more mature company than they used to be. They have custodial accounts, they have IRAs. So these are the kind of companies that I don't think I've added either in quite a while. But we're starting to get to the valuations where they're starting to get pretty attractive. Robinhood is still pretty expensive. Enterprise value to sales is still 12. I forget what my cost basis is, but my cost basis is probably in the 20s. So I'm happy to just ride that. I think I sold in December. I sold about half that position because I just thought the valuation had gotten a little bit nuts. But this might be one that I start to add a little bit more if the stock continues to fall. It's going to continue to be volatile, but again, over the next 10 years, 20 years, I think this is a company that's just really well positioned. Same thing with SoFi. Their member growth numbers are much more impressive. So that's the thing that I'm kind of looking at between those two. I kind of like Robinhood's products better, but it's hard to deny that that SoFi's member growth has just been kind of off the charts. Maybe you can explain a bit of basis that you invested per ticker in your portfolio. I have all of this information. If you want to look at all of it, asymmetric investing, asymmetric-investing.com. That's where I'm putting on my buys every single month. I do a deep dive on every single stock in the asymmetric portfolio before I buy anything. And then each month I give an update. So this will go out, I guess, in a couple of days. Wednesday, we'll go out and I'll tell everybody, here's what I'm going to buy today. Here's what I'm going to allocate to it. Here's why. So all of that information is available on Asymmetric Investing. If you are interested, if there's not a link in the show notes, there should be. Otherwise, I'll throw this up on the banner as well. So you got it up here. After I hide this, there you go. That's where you're gonna be able to find all that information. So hopefully that's helpful. It's I'm just not gonna be able to go through everything here, and that's what that side of the and I'm going through all those buys, by the way, on the YouTube Premium as well. I'm just trying to grow that a little bit organically. But that's what the idea there is if you're just a YouTube person and you just want to see a video, I'm going to try to put everything up that's a really high value there as well. ONDS is the question. Don't know this one at all. Never even heard of it. So I'm gonna punt because I don't know this stock. If you've been near a shopping plaza or mall in the last 2 weeks, you conclude there is no recession and none on the way. It's just if your data is just the shopping mall, I'm sorry. That's not how recessions and data work. Sure, people are still shopping. The people that are shopping at the mall probably are the people who have a lot of money to go shopping at the mall. Regular consumers we've already seen some pretty good weakness. Thank you to B Mark for watching for the last 10 months or so. Appreciate that. What are you doing with speculative bets like Joby amid the unrest in the Middle East? I'm not doing anything with any of them. I'm just leaving it. Joby's pulled back, I think about 50% or so. Maybe a stock that I, add to a little bit later in 2026. They've got a bunch of benchmarks that they need to hit, but they raised a lot of capital. I wrote an article about that for the newsletter that, they ended up raising $1 billion or so, not too long after that. So it gives them a lot of runway. If we do go through a big downturn, it seems like they've got the cash to at least get through the next 3 years, I think is just kind of my ballpark number. So I'm not doing anything with that one because it's, again, I'm not here to time the market. I'm here to find companies that are going to be able to 10x over the next 10, 20 years. But I don't know if that's going to happen in the next 6 months, or, I happen to get the timing on Robinhood and SoFi really well. I've not gotten the timing on other companies really well, but the fundamental business continues to get better. So Joby's doing all the right things. I like their business model. They've got a lot to prove though in the next few years. So I'm just I'm happy with what I own, but I'm not adding to anything quite yet. In your private group, do you point out which tickers are cheap and to buy at every moment? That's not what I do. What I'm doing is I'm showing what I'm doing with my money with the asymmetric portfolio. So the way that I've structured this is started the portfolio from zero. I add money every single month, and then I just follow the same principles. So I over index on not selling. I over index on companies that have that 10x or 0x potential, acknowledging that I may or may not be right about any one of these, but the winners are going to overwhelm the losers in your portfolio. So anybody that has been investing for a long period of time knows that 1, 2, 3 winners can really drive your outperformance of your portfolio long term. So that's exactly what the entire portfolio is built on. But this is not a day trading portfolio. So if that's what you're interested in, I'm just not the person for you. So that's just hopefully that's helpful in understanding every one of these stocks that I buy, I intend to own for the next 10 years. And in some cases I won't if the investment thesis changes, but that's the idea. Good Clarity TV, my HIMSS thesis, large customer base, proprietary data, labs and biomarkers, AI, more products, better treatments equals more customers equals more proprietary. Yeah, this is right. The big unknown here is the AI and more products part. We're a little bit chicken and eggy with those kinds of things. So can AI improve medical treatments, medical technology? If we have peptides, for example, is it going to tell you, hey, this is what's going to be effective for you? Here's what's going to be effective for Travis. Here's how it's different. Adjusted on the fly. All possible. We're just not there yet. So this is very much, if you think about like Netflix in 2010, you could see where they were going. They just weren't there. They hadn't built the thing yet. They didn't have the customer base yet, but the model was starting to work. Do you have thoughts on Nebius or IREN? My thoughts are this is just an area I'm not interested in investing in. I've done a lot of content on, and I do a show with Jose and Neil, Couch Investor as well, who follow that area much more closely. But I think we just don't know a lot about the ultimate return on investment. A lot of these artificial intelligence data centers and things like that. And I will take the easy bet, which is I own shares of Alphabet. That's really all I own in the AI space. But typically what happens here with these new technologies is you go through a time of hype, growth, massive growth, and then you hit some sort of wall for one reason or another. The dot-com bubble happens and pops. You hit the great financial crisis in 2007, 2008. And then, so what happens when things pull back? We're seeing so many exponential curves in artificial intelligence today that they're not all going to continue infinitely forever. So, the investment with the hyperscalers is like $700 billion this year. Is it going to be up 50% in 2027? Probably not. But is it going to be flat? Is it going to be down? We don't really know. So I want to buy companies, artificial intelligence companies, in that trough of disillusionment is what they call it, where the bubble bursts, everything drops. Because then suddenly you go, oh, this wasn't real. This was, there's no ROI here. We're going to get to that point someday. And that's when I want to pick up the pieces and buy the Amazons, the Netflixes, the Googles, because those companies will exist in artificial intelligence. The companies that are just neoclouds, I look at them more like utilities, and they're not profitable. They're using a ton of debt. There's just a lot of risk factors that I'm not interested in, kind of putting my name behind. Same thing with, I've been saying Oracle is one of the worst stocks to own for the last year, and that's turned out to be right. But that's my thoughts. Is that it's not an area that I want to be investing. That said, they might do really well over the next year. I know it's pretty expensive right now, but Kava is growing locations very quickly. Same store sales are up in a recent report. What do you think about Kava? I've looked at it. It's always been a little too expensive. And you're always, with those kinds of companies, going to hit a wall. I believe their same store sales growth did go negative for at least one of the past few quarters. So look, you got an enterprise value to sales of 7, 8, almost 8. Price to earnings multiple is 145, 138. There's not a lot of value here, and I know that is a massive, massive growth company. But restaurants are really, really hard, and I'm not sure that this is I just have not gotten to the point where. The other thing here is we don't have Kava near me, so I can't even try it. So I know people who swear by Kava. Not something I've even tried. So it's hard for me to give a strong opinion. What do I think about space in 2026? Your picks amongst Rocket Lab, is that Planet Labs and Redwire. Is an area that I'm just, again, staying out of. This has gotten to be very, very bubbly, and we don't know. Most of these companies are not profitable, and like Redwire is not. Planet Labs also not profitable. Rocket Labs also not profitable. I just don't know who has a competitive advantage here and why. If you think that Rocket Lab has a competitive advantage, why isn't SpaceX? If SpaceX has a competitive advantage, why doesn't Rocket Lab? So it isn't to say that some of those companies won't be phenomenal. It's just, if I can't explain the investment thesis on why this is going to be a 10x investment over the next 10 years, then it's just not an area that I'm going to invest. So space is very hot right now. Does not mean the economics are great. And with SpaceX probably coming public in the next maybe month, 2 months, that's going to suck a lot of oxygen out of the room, and that's going to be an insane IPO. And I mean that in a lot of ways. It is going to be one of the most valuable companies in the world, and they're not profitable. We haven't seen the S1 yet, but yeah, that's going to be a crazy one to watch, because I don't know what's a sustainable business model there. I got a lot of questions. I got a short position on AST Space Mobile through long dated puts, because again, are you going to be able to make money doing telecom from space? I don't think so, but we'll see. Again, I can also just not invest in some of these, and sometimes that's the right answer. On and Rocket Lab. So I talked a little bit about Rocket Lab. Let me pull up on here. This is one of my favorite stocks right now, and let me explain why. On now has an enterprise value to sales of 2.7. Okay, a 5-year. Well, let's just go to the 3-year because it's a little lower. 3-year compound annual growth rate of 35%. Let's look at Nike. Enterprise value to sales is 1.7. So it's only about 50% more expensive, but Nike not growing. So when you look at the risk reward of these companies, I think On has got a phenomenal risk reward. The other thing is On's gross margins, industry leading, 63% gross margin over the past 12 months. That is absolutely phenomenal. How much better is it than Nike? Nike's is 41%. EBITDA margin, 8.2%. On has an EBITDA margin of double that. So you add all these things together. I just think the risk reward for On is really strong. It's one of those high-end brands that, if we do go into a recession, everything is going to pull back. Spending on everything is going to pull back. But the people who are buying On shoes probably going to continue to buy On shoes. Maybe buy a few fewer shoes, but this is not going to be, we're not going to go into like Under Armour territory where they're going to be in serious trouble. So I love the risk reward for On right now compared to a lot of the companies in their space, and just the fact that the market is disappointed by guidance of 20+% growth, which I think it was for 2026. And by the way, their numbers get really wonky because they report in Swiss francs. I wish they would just report in US dollars. It would make it a lot easier for everybody. But love where they're sitting right now, and where that valuation, that risk reward valuation is sitting right now. WEGYF. I have not looked at this one. So I'm gonna punt here a little bit. Building EV projects. I have been. Oh, this is a teeny tiny company. Yeah, no, not interested. So I have been in this renewable energy space, following the renewable energy space for a really long time. It's really, really hard to make money. It's just the reality. It shouldn't be that complicated. Brookfield, just buy Brookfield if you're interested in renewables. Just Brookfield Renewable, or whatever it's called now. That's keep it simple. Lots of people are saying gold will be the biggest winner of the year. I tend to agree with them because we're in for a lot of inflation. Fun fact, look up the history of when inflation actually happens and what happens to gold when there is actual inflation. Gold is a phenomenal hedge for the idea of inflation. Gold is not a phenomenal hedge when we actually get inflation. Same thing with something like Bitcoin. So I just want to throw that out there, that when you had inflation in like the 80s, gold, I think, did well the 5 years before that, but then it did not do well while there was actually inflation happening. So gold is up right now. That may mean inflation is coming. It doesn't mean that gold is going to be a good a good hedge while there is inflation happening. So just a word of caution there. I do not buy gold. I do not own gold. I do not have real thoughts on gold because it's just not. I don't understand that entire world. I want to own productive assets, and over a long period of time, you're better off just buying the S&P 500. Any thoughts on UiPath? No, sorry, I just don't. One of my favorite companies right now. I'm going to be working on something about Uber that'll be published on YouTube probably tomorrow. Does Uber have 10x potential from here? Is autonomy as big of an industry as hypothesized, and are Google and Tesla big components? Yes. So again, this is go back to the smiling curve that I talked about. Uber owns the demand. That is the real key point in the value chain when you're looking at ride sharing, when you're looking at ordering food. They've added all kinds of physical products from retailers. So my thesis, and this goes back to, I think I first covered Uber and Lyft, and again, I covered both of those in a basket. So my thesis on both of those companies was they were going to own demand, and what was going to happen was supply was going to simply go from the human driver to the autonomous driver, which is going to ultimately increase the amount of supply that's available. So you go onto Uber or Lyft on a Tuesday night, let's say, you're going to see how many people are within a 5-mile radius of you. So let's say it's 10 vehicles are within a 5-mile radius of you. In a world of autonomy, why wouldn't there be 20, 30, 50 vehicles within a 5-mile radius of you that are just available 24/7? If that happens, then you're going to increase your demand, because now it's going to be, instead of it being a 15-minute wait to get a ride, I live in the suburbs now. Now it's a 2-minute wait. Now, by the time I get my jacket and my shoes on, there's a vehicle waiting for me. And on top of that higher availability of supply, you are likely going to, we have not seen this yet, but everyone has indicated this is where we're going, is the cost will come down. So the current human driver costs between $2 and $3 per mile for an Uber or a Lyft ride. In the future, it is likely that autonomous vehicles will be somewhere around $1 per mile. So if a $1 per mile ride is available within a minute or two, almost anywhere you are in a major city, that is going to expand the market for Uber in a dramatic way.
there's all kinds of other things that could happen, innovations that I think will likely happen. Like, why wouldn't it be the case that I do an order from the grocery store as I'm going to bed at night, and then something like a Zoox vehicle with a little robot in it is just parked, in the street in front of my house, and then just delivers my stuff at 6 a.m. or 5 a.m. No, nobody's demanding vehicles at that point. So why isn't that stuff? I just think there's going to be a ton of innovation done in those off hours that we just aren't even thinking about today. That's always been the complaint. Oh, these vehicles are only going to be busy between 7 a.m. and 9 a.m. and 4 p.m. and 6 p.m. or whatever the peak hours of demand are. We're going to innovate and figure out things for these cheap vehicles to do on those off hours. And so that's only going to expand the moat for the companies that are the source of demand. So I think that's what I think. I love where Uber's sitting right now. The market obviously does not, because I think I'll just give away, this is probably going to be one of the stocks that I buy in April, because price to earnings multiple even on a forward basis. So they had some one-time things in the past 12 months, but on a forward basis is under 20, and their 3-year growth rate is 18%. If you owned 20 companies that were trading for a price to earnings multiple under 20, and their growth rates near 20%, and they have operating leverage in their business, and their moat is getting bigger as they scale, you're going to do extremely well as an investor. So, yeah. Last one I've got here. So last call for any questions, and then we'll hop off here. Thank you, Travis, for all the work. Thank you for everybody for watching. 100, almost 200 people here. Phenomenal to have this live. So appreciate everybody that showed up. Any thoughts on QuantumScape? If I'm remembering my tickers correctly, with solid state batteries. Again, on my radar, something that I'm watching and interested in. Have never been able to invest in them because I just don't know what the economics are. I'm just looking at they lost $435 million on zero revenue last year. Again, this is one of those companies, and we go through this with a lot of industries, where it's okay to just watch it and go, I'm really interested in solid state batteries that could be really disruptive in a lot of different ways, but we don't know what that's going to be in the future. And the analogy that I would give is to an industry I followed for a long time, really, really closely. That's the solar industry. So my thesis in the early 2010s was solar was getting cheaper. The cost was coming down extremely quickly. Demand was going to exponentially rise. We were going to increase our solar production at an exponential rate. Guess what? Both of those things happened, and there was almost nobody who made money. So could it be the case that solid state batteries are the future of transportation, or the future of energy storage, all of those things, and QuantumScape makes no money? Yes, that is possible. So just kind of a quick word of caution there. So again, on my watch list, don't have a position because I don't really have that. They confirmed my thesis, kind of a thing. Thoughts on real estate brokers? Reacts coming open in comparison to aggregators like Zillow. So my bias here is I negotiated out the buyer's fee when we bought our house, and because I don't think the real estate broker model wins long term. I think the idea of paying 6% to a broker who's going to do the exact same thing that I'm going to do, which is pull out Zillow. I mean, I looked at a house with my wife about a year ago, and we asked some questions, and you could tell the broker, this would have been the buyer broker. We were connected through Zillow, but it would have been potentially a buyer broker. She had never been there. She had never really researched the house, and she literally was pulling up Zillow to answer questions that we had about the house. If you want to look at Zillow's recent AI presentation from Tuesday last week, I think it was, maybe Wednesday, a lot of really good information about what they're doing for brokers. Then imagine that world that the broker doesn't exist and the AI is just answering those questions for you. So I like the aggregator. Open Door the stock has done really well. The company has not. Um, and that's one that, I mean, they might be bankrupt in 3 years. Let's see. Yeah, I don't know. They lost $1.3 billion last year. Is that a sustainable business model? I I don't see it. And look, I bought into the iBuying hype a few years ago. I have rethought that. Any thoughts on Reddit? Not great thoughts. It's I understand why they're doing better. They've been able to monetize their content, which is the kind of content that these LLMs need. Um, I hate Reddit. I can't stand the product. So maybe that's my bias, is that I'm not really interested in owning a company that I don't understand. I don't understand using it. So again, we all have blind spots. Reddit is going to be a blind spot to me and will continue to be. Um, how bad, in your opinion, do you think this downtrend is going to be? War, private credit is imploding because BlackRock has locked people in. By the way, that private credit part, that's part of the contract. You don't invest in private credit and then be able to expect your money back at a moment's notice. So when they say like limited withdrawals, that's the deal. That's what you get with these things. So yeah, just take that with a little bit of a grain of salt. And stagflation on the horizon. Are we looking at a 20% plus drop? It's absolutely possible. If you want to see my, more thoughts on that, go back to the beginning of the show. The replay will be up here on YouTube. But we have not had a real recession or real pullback in the market in 17 years. So it's very possible that we go through one of those. That would be very, very normal to go through a period like that. And the market itself is still very, very expensive. So you add all those things together, and it is very possible that the market goes down 20%, 30%, 50% is even possible. We're in correction territory with the NASDAQ. That means that the NASDAQ is down over 10% from its high. May not be as I'm recording, but it was right at that, bouncing at that level on Friday. S&P 500 hadn't quite hit that point. But yeah, if we go through a real recession, and like I said, if you have not been investing for over 20 years, over 17 years specifically, you just reality, we have not had a normal recession in a market. There have been downtrends. There have been, areas of weakness. We went through COVID, which was weird in a lot of different ways, both negative and positive from a market perspective. But that you look back historically, COVID was 100% an anomaly. Much more normal is what happened in 2001 to 2003, where there's just a recession in the last 2 years. The market drops, the bubble pops, things go down, but it lasted a long time. It was 13 years, I think it was, till the NASDAQ hit its all-time high, and the S&P 500 even took 13 years to sustain an all-time high. So these things can happen and can last for a really long time. So don't let anybody tell you that, you have to buy now. You got to buy this dip because we're going to be up in, I don't know, maybe we're not. Just don't, I'm not overextending myself, because I'm just adding every single month, because I know historically that is the best way to beat the market. Maybe we're down 20% 6 months from now. Maybe we're up 20% 6 months from now. I would not have predicted in April of last year that we would have had that I would have, or the asymmetric portfolio, I think, was up 35% last year. I would not have predicted that in April of last year. So know what you can predict and what you can't predict. I have no idea what is going to happen with the war, with stagflation, but I know that all these things are possible. And historically, we're going to go through some sort of downtrend in the market, pullback, drawdown, whatever you want to call it. And I'm going to be, my triggers to start buying more is when the market goes through a 20% drawdown. I double my investment. 30% drawdown, I kick it up more, 40% kick it up more. That's what I have ingrained in the asymmetric portfolio, because I want to ingrain that being greedy when others are fearful. So that's what I'm doing. That's what I'm showing on asymmetric investing with, with the portfolio that I'm doing there. So, if you want to see what I'm doing, the link on the screen, I think there's a link in the show notes. If there's not, I'll put it in just after the show. But that's the way that I'm thinking about it. It is possible that we go down 20% from here. I don't know that it's necessarily likely, but we'll see. Final question. I'll just put this up there. Thanks for the kind words, everybody who's put those in here. Is your strategy also to add value in dividend stocks or only growth stocks? I do have what you would consider some value stocks in the asymmetric portfolio. I'll just highlight two that I think are crazy price today. MGM Resorts. I did a video on them on YouTube, so you can go back a couple of videos ago. If you pull out, management does this periodically, but if you pull out their 50% ownership stake in BetMGM, so just do a market multiple on that, and then pull out their Macau business, which is publicly traded. I think they own 56% of that. If you pull those two things out, their core business trades for like 3 or 4 times the cash flow that it's generating. So that's why they're buying back 10 to 15% of their shares outstanding each year. The other thing they're investing in is the Japan resort, which may be worth more than that single property, may be worth more than all of MGM Resorts is worth today when it opens in 2030. Just look at what Marina Bay Sands in Singapore generates, almost $3 billion in adjusted property EBITDA. That's the potentially Japan will be bigger than that. At least it's going to be in the same ballpark. So MGM has a $9 billion market cap, I think, as we're recording today. And I think that's just crazy. The other one is Lyft, trading for, I think, 11 times earnings. Free cash flow is growing. They are the number 2 player to Uber, so I own both of those. But, Lyft is the value play. I also think if anybody's going to get bought out, it's going to be Lyft. And so Amazon, I think Amazon buys Lyft by the end of the year. But yeah, there are reasons that I would own what you would consider a value stock. Dividends, I don't really worry about on the asymmetric portfolio. It's not in the corpus of what I'm doing with asymmetric investing specifically. Doesn't mean that they don't belong in other portfolios, but with asymmetric investing, where I'm looking for 10x stocks, typically a dividend play is not going to be in there. There's a question that just came in. I talked about Nebius 20 minutes ago or so ago, so you can go back in the replay. Give my thoughts there. Do you ever sell puts to get a better price entry to at least keep the premium? I have in the past, and the reason that I typically don't now is I often found I was missing out on the real benefit. So if you're really bullish on a company, just buy the stock, or that's what I do, rather than selling puts. Because if you want to own the next 10x company, you're gonna miss out. You might miss out on it Same thing with covered calls. I've done covered calls in the past. Why do I own the stock if I'm selling a covered call? So for my strategy, it's just not something that I do much of. So, all right. Thank you everybody for joining. An hour and 45 minutes. These always end up being a little over an hour, but I will be back on the premium side, both here on YouTube and on the newsletter. Both of those will be available. I will be back either late this week or early next week to discuss what I send out that I'm buying for the asymmetric portfolio in April. So that will come out before the market opens on April 1st. If you are a premium subscriber, keep an eye out for that. Lot of good opportunities today, I think. So we will definitely be adding. I'm taking a pretty risk-off approach, just like spraying with all of my 5 best ideas, or for example, because eventually one of those is going to work out over the next few years. But thanks everybody for watching. If you are not already, please subscribe to Asymmetric Investing. Hopefully everybody gets a ton of value out of that. It's $100 a year, so hopefully you're get about 4 emails plus a week for that. So all my research that I'm doing. So let me know if you have questions there in the newsletter or here on YouTube. Thanks everybody for watching. We will see you next time.